We've reported a good set of results in a tough market, and these results show we're doing the right things. Our performance is the result of successfully executing a clear strategy, growing income, growing capital value, adding incremental value, controlling our costs, and using our scale to our advantage. These priorities inform our long-term decisions as well as our short-term actions. In the first half, we've seen strong and high-quality letting activity, another successful period for our developments, achieving successful refinancing as well. And we've established a new joint venture with Norges at Meadowhall, an exciting and important partnership which matches the importance of Meadowhall as an asset. Our strong operational performance in the first half has led to income and profit growth. We've delivered a 1.1% growth in our net rental income and a 3.8% growth in underlying profits. Our NAV has increased by 0.8% since September 2011, and it's up a penny since March, at a time when the broader market has actually declined. We've also increased the dividend by 1.5%, reflecting our confidence in the future of our business. We've significantly outperformed the UK property market again by a material amount, and our operating metrics remain strong. Underpinning all of this is our customer focus. This enables us to provide great buildings with the space modern businesses want. It's why our portfolio remains nearly fully occupied and why our developments let so well. We've signed over 900,000 square feet of lettings, lease extensions and lease renewals. We've continued to sign deals ahead of ERV, adding 5.9 million of new rent, all in a slow market with little, if any, rental growth. In offices, our focus on quality buildings and customer service means occupiers are opting to stay in our buildings. Over the past 2 years, we've extended nearly 1.5 million square feet of leases, 412,000 square feet of that in the last 6 months. We've also agreed nearly 100,000 square feet of lettings in our investment portfolio. We're not only extending income, but adding value as well. In retail, we've continued to outperform, including on footfall. We agreed over 400,000 square feet of lettings and renewals at 3.1% ahead of estimated rental value. Retailers that have acclimatized to the tougher trading environment are continuing to upgrade their stores, and this is creating demand for the best retail locations. We are big beneficiaries of this situation because of the quality of our portfolio. Fort Kinnaird in Edinburgh is a great example. This year we've signed 8 leasing initiatives. We're leveraging our strong retailer relationships, bringing in new trading formats, and adding a cinema and 6 restaurants. We've seen a 4% increase in footfall, which compares to a 2.5% decline across the broader Scottish market. 2 years ago, we started a number of developments, and we're now reaping significant benefits. We crystallised £50 million in development profit in the first half alone. The expected profits have grown from £250 million to nearly £400 million, as we've benefited from pre-lets, competitive tendering, and the unlet space as values grow. By the end of next year, 4 out of our 6 office developments will have completed. Leadenhall is now built as far as level 26. Whiteley Shopping Centre, which opens next spring, is already nearly 80% pre-let. And this shows how our understanding of the retail market has helped us to create a desirable next-generation retail destination. We're also building future growth into our portfolio. A great example has been our purchase in the last 6 months of the Clarges estate, which is going to become a fantastic office and residential development in the heart of Mayfair. This will continue to help us fulfill our strategic objective of rebalancing our overall office portfolio toward the West End. We're recycling capital too. We've sold 350 million of mature assets, including a number of superstores and the Beehive Centre in Cambridge. We're reinvesting in assets with better growth prospects, principally those with development potential. And we expect significantly higher returns from those new investments than those which we sold. The advantage of our scale is most evident in financing. We continue to secure a diverse range of finance at competitive rates, and these are simply not available to many others in the industry. From my perspective, access to low-cost, flexible finance is a key competitive advantage. In total, we've raised over 900 million from 7 different sources since the start of the year, and 2.5 billion in the last 18 months. That's a third of our debt book. Perhaps most significantly was the convertible that we issued back in September. We were the first REIT to do so after the summer recess, and we got, quite simply, great terms. So we're following a clear strategy which is delivering results. We believe current market trends are broadly in our favour. This is shown by the relative strength of our portfolio in what is a difficult market. We're also investing for the future, and we're confident that as the economy improves over time, so we will be able to deliver growth.